So our next question is question number 6A. Simran Private Limited holds 55% shares of AL Kuber Limited, a company incorporated in Dubai. Now, AL Kuber Limited has its office in India also. Now, this company is having office in India also. And details relating to the assets and other information of this company for the March and year ended March 20, they have been stated below. Now, they are asking here, in this particular case, we are required to determine the residential status of this AI Kuber Limited. Now, in this case, the company is what? Incorporated in Dubai. Company is incorporated where? In Dubai. So here, it is a foreign company, and foreign company will become resident in India if its place of effective management during the previous year is in India. Okay. So now for determining whether the company is engaged in place of effective management, we have to see whether company is engaged in active business in India or not. Now here it has been provided that a company is said to be engaged in active business outside India. A company is engaged in active business outside India. A company is engaged in what? Active business outside India. When, if the passive income, number one is what? If the passive income, these tests are to be satisfied, is not more than 50% of the total income. Number one test is this. Number two is what? When it is said to be active business outside India, less than 50% of the assets, 50% of the total assets is situated in India. Then number third is less than 50% of the total employees, they must be what? Situated or resident in India. And the payroll expenses of such employees who are in India, the same must be less than what? 50% of the total payroll expenses, and then majority of the BOD, majority of board of directors meeting is outside India. These tests are to be satisfied here. Now, first of all, look what is passive income. As you are, it is say when purchases are made from the associated and goods are sold to the associated enterprise. When both purchases and sales both are from the associated enterprise, then in that particular circumstance is known as what? The passive income. Okay. So here, and rental income, interest income other than banking company, dividend income, they are coming under the ambit of passive income. So look, first of all, the income criteria test we'll be seeing. Income criteria test. It's a total income. Total income is how much? Total income. Income from trading operations 730 plus 1370. 730 plus 1370. Then we have, this is included in the above figure, plus 560 and 320, plus 560 plus 320. So the total income is how much? 370 plus 1370 plus 560 plus 320. That is 2620. 2620. 730 plus 1370 plus 560 plus 320. So it is 730 plus 1370 plus 560 plus 320. 2980, sorry, it's 2980. Okay. So this is the calculation aspect. You have to see it. Then what is the passive income here? Look the passive income. First one is what? Income from transactions where sales are made to, it won't be coming under the ambit of passive income. Income from transactions where purchases are made from the associated enterprise, it won't be coming under the ambit of, say, passive income. Income from transactions where sale and purchases are to and from AE, this will come under the ambit of passive income. So passive income, that is 40, 45 plus 80, it is what? 45 plus 80 plus 560 plus 320. So 45 plus 80 plus 560 plus 320, that is 1005. 2980. So the percent works out to be how much here? 1005 divided by 2980 percent, that is 33.72%. So its passive, first test is satisfied. Its passive income is not more than 50% of total income. So we have satisfied the first test. Then second is the assets tests. Assets test. Now here, what is the total assets which are of this company? That is 1500 plus 650 plus 225 plus 1075 plus 800 plus 1900. That is 6150. Assets are how much? 1500 plus 650 plus 225 plus 1075. Then we have 800 plus 1900. So the total works out to be 6150. That is 1500 plus 650 plus 225 plus 1075 plus 800 plus 1900. And assets situated in India. Assets situated in India are how much? 1500, 225, 800, and these are what the assets which have been situated in India. 1500, 225, and 800. That is 2525. So percentage of assets situated in India. So it is 2525 divided by 6150 into 100. That is 41.05%. Second test is also satisfied, less than 50% of the assets, of total assets, less than 50% of the total assets are situated in India. Are situated in India. Then the next is what? Employees test. Look here. The total number of employees is 70 and 90. Unskilled out of the above mentioned total employees, they are resident of respective countries. So we have to consider in all. So total employees is 160. Employees in India is 70. Employees in India 70. So percentage of employees in India, that is 70 divided by 160. 43.75%. Then payroll expenses. The third test is also satisfied. Less than 50% of the employees are in India. Then of the total employees. Then payroll tests. Total payroll expenditure. What is the total payroll expenditure? That is 940 plus 1250. So 940 plus 1250, 2190. So percentage of payroll expenditure in India, percentage of payroll expenses in India, that is 940 divided by 2190 into 100. That is 940 divided by 2190%, that is 42.92. So less than 50% of the total payroll expense of such employees is in India. So all the four tests are satisfied here. Besides this, majority in comparison, here are 3 meetings are held. Outside India is 4 meetings are held. So majority of the board meetings are also outside India. In this case, the place of effective management is outside India. Hence, such company is non-resident in India during the current concerned financial year. So this type of question has been asked 4 to 5 times now in exam. So basically, we have to see the test. This type of question is asked to see the test and then verify whether the company is engaged in active business outside India or say it is an active business in India to determine the residential status. Next question is, Mr. Anand, a resident of Bangalore, has 2 house properties, one situated in Bangalore, one is in Bangalore, other is in Jaipur. The house property at Jaipur was purchased in 1998 and the Bangalore was purchased in May 2008. Mr. Anand has transferred his house property at Jaipur in name of his son, Pratik, on 10th birthday in July 2002. So the property is basically transferred to his minor son. Property is transferred to minor son. Okay. In September 19, the tax recovery officer served a notice on Mr. Anand for recovering outstanding tax arrears of rupees 150 lakhs relating to AY 16-17. Now this relates to assessment year 16-17. TRO has served a notice in respect of his proprietorship business. TRO simultaneously attached both the houses for recovering the tax arrears along with the interest. Now, he has what? in exercise of the powers which have been granted to the tax recovery officer, he can attach the movable and immovable property belonging to the assessee. Now, Mr. Pratik has been staying in house at Jaipur with his wife for last 4 years after he got separated from his father. Now, in 2002, he was minor, and 10. Now, in 20, he has celebrated 10th birthday. Now, in July 2020, basically, he has become 8, means July 2020, July 10, he has become major, and now in September 19, the TRO is serving the notice. The current value of house in Jaipur is 45 lakhs and Bangalore is in what? 90 lakhs. Now, Mr. Pratik seeks your advice on the validity of action taken by TRO in attaching the Jaipur property. Now, basically what has been provided in the explanation which has been provided in section 222 regarding how the TRO will affect the recovery. So, he can attach the movable and immovable property of the assessee, and movable and immovable property of the assessee will include any property which has been transferred to his minor son or say son's wife or son's minor son without adequate consideration in case the same has been transferred here. So, that is including the assessee's movable and immovable property if say the same has been transferred to his spouse or son's wife, minor son, and now here son's minor son is also covered. That will be included. But the important aspect is what? The tax dues must pertain to period prior to the date of attainment of majority. Here, the tax dues basically must pertain to the period prior to the date of attainment of majority. Even if he has become major, the same can be recovered. But the important aspect is the tax dues must pertain for the period prior to attaining such majority. Now here the tax dues is related to period AY 1617 when he has already become say major. He has celebrated his 18th birthday on 2010. So therefore the action of TRO to recover the tax by attaching property in possession of Mr. Pratik, where it is, that is property is in Jaipur, is not correct. The same is what? Not correct. So here the action we can, Pratik can what? Challenge the validity of the action which has been taken by the TRO by attaching the property which was in his possession, because that property has been transferred prior to what arrears must relate to the period prior to the date when he has attained the majority. So that house property has been transferred and tax arrears here are for AY 1617. Next question is ND Limited, an Indian company. ND Limited, an Indian company, has borrowed 90 crores on 1/4/19. Now it has borrowed what? ND Limited is an Indian company. Now ND Limited here is an Indian company. It is what? An Indian company. Now it's borrowed rupees 90 crores. This 90 crores have been borrowed from Measures TINC, a company incorporated in London. Measures TMINC. This TMINC is incorporated in London. Now here, rate of interest is 10%. And when the same has been borrowed, on 1/4/19 it has been borrowed. Now further they say that the said loan is repayable over a period of 5 years. It is repayable over 5 years. This loan is repayable over 5 years. And this loan is guaranteed by measures TYINC. This has been guaranteed by TYINC. This loan has been guaranteed by TYINC, incorporated in UK. This is incorporated. And TDINC are non-resident. TDINC is a non-resident. It is an NR. Now here TDINC holds shares carrying 40% of the voting power. TDINC holds shares 40% of the voting power of TYINC and ND Limited. 40%. Now since if an enterprise owns 26% or more of voting power in one person holds 26% or more of voting power in ND Limited and the TYINC. So ND Limited of India and TYINC of UK, they have become what? Associated enterprise by virtue of this, by virtue of TDINC. Now the associated enterprise have given a guarantee to the person who has been providing loan. So here the provisions of section 94B stands attracted. As we have seen, there is a limitation of deduction on account of interest borrowed from associated enterprise, or when the associated enterprise has given a guarantee or has provided a back sum to the person who has given the money on such a loan. So now this provisions of 94B stands attracted. Therefore, the deduction on account of interest shall be what? Lower of the interest so paid to associated enterprise, or 30% of earnings before depreciation, interest, tax, amortization. Now what they are saying is, net profit of measures ND Limited for previous year 1920 was 11 crores after debiting the above interest. Above interest works out to be 9 crores. Depreciation 5 crores. Depreciation 5 crores and income tax 4 crores. So first of all, we will be calculating earnings before depreciation, interest, tax and amortization. So net profit before, say after depreciation, interest, tax is 11 crores. So we will be adding back the interest, add interest paid to AE. We have paid interest to the extent of 90 into 10%. 90 crores into 10%. That is 9 crores. Depreciation is 5 crores. IT is 4 crores. So it works out to be 29 crores. So allowable interest will be, this is earnings before depreciation, interest, tax, amortization. So allowable interest will be what? Lower of. Number one is 30% of 29 crores, or number two, the interest so paid 9 crores. So it is 30% of 29 crores. 29 crores. That is 8.70 crores. So disallowed interest will be how much? Disallowed interest will be 0.30 crores. Now the same will be carried forward for 8 assessment years succeeding the AY in which it was disallowed, and same will be allowed in the year when interest outflow to AE is less than what? 30% of earnings before depreciation, interest, tax and amortization. So this is one question which we have discussed. So this was the last question, I think so. This was the last question. So the overall paper was not very difficult. It was an average paper. If you have prepared with the past suggested answers, or we have a compiler, so this paper was an easy one in comparative to the other papers when we see of the direct taxes. So it was an average one. So you can easily score good marks if you have already made good practice of the past year's exam questions, RTPs, mock test papers. And these types of questions have been given by us in our test series also. We have uploaded the same, so you can go through the same. And those students who are opted out and now they are appearing, they will be appearing in January exam. They must also practice more and more questions so that they can score good marks. So overall, the paper was very simple, and in comparison to the earlier papers, and they can score good marks in this paper, provided how you attempted your multiple choice questions. That is also a major 30% of weightages of that. So next paper is indirect tax laws. So work hard for the same also, and then let's see, wait for the results to come. All the best for your indirect tax laws paper.